All right. How to increase your credit score. So there's 3 big factors that are included in your credit score calculations. But first, what is a credit score and why the is it important? Basically, your credit score is your reliability score that lenders provide and score you based on how reliable you are on paying back your loans. It's like a report card, essentially just for big banks to see how reliable you are on paying back the money that you borrow. That's basically it. Unfortunately, this is one of the biggest things that is important for us Americans. This number is extremely important in terms of getting car loans, house loans, renting apartments, even getting a new cell phone. And unfortunately, the percentages that come along with these credit scores can vary extremely wildly based on what number you have. So how do you increase it? The biggest and most important thing is payment history. This is by far the most important. This makes up 35% of your credit score, and lenders want to know, do you pay your stuff on time? Every time you make an on-time payment, whether it's a credit card payment, loan payment, student loan payments even count to this, it helps your score. But if you miss a single payment, pay late, or your account goes to collections or something like that, it puts your credit score right in the ass. Like, it drops it by 50 points sometimes. I had collections on an old account. That one went down by like 100. Every time you miss a payment, it drops your credit score hugely. These negative marks can stay onto your credit report for up to 7 years. So basically, just don't miss a payment. How do you do that? So you want to do calendar reminders, automatic payments. For automatic payments, you would want to schedule a date that works for you when you have the money available to pay for that credit balance, or at the very least, the minimum payment. And use a calendar reminder to let you know that this automatic payment is coming up, basically to make sure you have enough money in that account. I've had it to where my automatic payments were scheduled for a certain date. I did not have enough money in my checking account to cover that, and after having a payment bounce twice, they closed my red card for me. Closing a credit card can have really big negative effects on your credit score, and you really don't want to do that. But if you miss payments, sometimes they will close it for you, and that's just gonna fuck everything up. The next biggest one, this one is at 30%, so again, a huge chunk of your credit score calculations. This one is credit utilization. This is a fancy way of saying how much of your available credit are you actually using. So imagine you had a $5,000 credit limit on one singular card. So you can spend up to $5,000 on this singular card. Let's say, for the same example, you're carrying a $1,000 balance. So currently your statement balance is $1,000. That is a 20% utilization rate, which is your current balance over the total amount of credit available. So again, 1,000 over 5,000, 1,000 being the balance, 5,000 being the total credit limit that you have, that is 20%. And they score your rates based on that percentage. So a 20% utilization rate, that's pretty good. There's a range of this, and I'll put something on the screen. Typically, I think 11 to 30% is good or average. Really, you want to be at 10% or below. This shows credit bureaus that, you have all of this credit available, but you're not using it. You don't need to use it. You're not a risk. So it heavily boosts your credit score. Over time, if you open more cards, get a car loan, these are different types of credit lines, you would want to calculate your total over this and make sure that you're staying at least, I would say 20%. 20% or below is a good area to aim for. This is every single credit balance that you have. Not too sure if that includes student loans, but I'm pretty sure it might. Take everything, total statement balance as of right now, over your total credit limit across all accounts. How do you keep your utilization in check? So you want to pay down your balances before your statement closing date, not just the due date. So your due date obviously is the date that your minimum payment is due to the credit bureau or the bank. This is the absolute latest. However, the statement closing date, that's the date that the bank or whoever you're doing business with that you have the credit open with, that's the date that they report your current situation to the credit bureaus. So if you pay down your credit balance before the statement closing date, they'll report that you have made more progress to the credit bureaus, which will affect your credit score before the payment date. There's like a lot of stipulations to this. Basically, you just have to keep both dates in mind. Personally, I would split all my payments twice. Let's say my minimum payment for the entire month is $50. I would make sure I pay half before the statement closing date, so that they report to the credit bureaus that I've paid part of my balance already. So my balance goes down, and then pay the rest of that, the other 25, on the payment due date. That's how I keep track of it. You don't have to do that. You can pay it all on the payment due date if you want. you're still getting your balances down, you're still getting your util up. It's the same thing. If you want to pay it early, you can. Just make sure it's before the statement closing date. Then they'll report that activity to the bureaus. If you're comfortable, you can ask for a credit limit increase, but don't use this as an excuse to spend more money. By increasing the credit limit, again, the formula is total statement balance over total credit limit. If you're increasing the denominator, you're essentially lowering your percentage by hardly putting in any effort. In my experience, they only will do this if you're a really good borrower of money. You've never missed any payments. You've done everything you're supposed to in terms of borrowing money. They might be willing to increase your credit limit. This will lower your util as long as you aren't using that credit limit to spend even more on that card, for example. Another thing you could do, spread your spending across multiple accounts to keep individual utilization rates low. This one's just kind of a minute one. If you don't want all of your credit util to be calculated from one singular account, you can spread that 1,000 across multiple cards. Each credit card will have their utilization rate at a certain percentage, which would help with the overall percentage. This one, I don't necessarily practice this one myself, but if you really need all the points that you can get, I would suggest spreading your spending across multiple cards. Again, it's not that important, but it's just another small thing that you can add to basically increase your efficiency in terms of raising your credit score. The last thing, this one is for the really responsible people who have the means to do so. Paying off your balance in full each month not only helps your score, but also saves you from paying interest. Again, this is for people that are extremely, already financially conscious. You are only putting on credit cards the money that you already have. So you're only using the credit cards for the points, the cashback, the rewards that you're getting from those systems, but you're not spending money that you don't already have. And then you pay that off in full. You don't have to worry about interest. You don't have to worry about any of the other stuff I talk about basically, because if you're paying the entire balance in full, your credit util basically takes a huge step down, all of these things. But again, that's already if you know what you're doing, but that's one to keep in mind. Pay off your balance in full each month, helps your score, saves you from interest. That one's a good one. The third biggest factor in your credit score is length of credit history, and this one is 15%. So this factor basically looks at how long you've been a borrower of money that's not yours, essentially. This includes the age of your oldest and newest accounts and the average age of all of your accounts. So the longer your history, the better score it gives you, and it gives lenders more data to see how reliable you are, basically. So a few tips for length of credit history. This one's kind of like, it's in your hands still, but it's not as easily malleable as the other two. The things that you can do here to really help, like I mentioned earlier, don't close your oldest credit card. Even if you don't use it, it's just going to lower your average age of history for your length of credit. That'll really hurt your credit score. Usually, if your card doesn't have annual fees, keeping them open helps your average account age. So you might as well just keep it open. Maybe, buy a pack of gum at the store on the old card, pay it off right after you're done for the month. It's an easy way to make sure the card isn't being registered as inactive or anything. As long as you don't close it won't hurt your credit score in terms of the credit age. If you're new to credit, let's say you're 18 or something, you could consider becoming an authorized user on a family member's credit card. If your parents have good credit scores and they're not behind on their payments, you would ask them to put you as an authorized user, and basically it's like you're in conjunction with them as owners of this credit line, so you're benefiting from the age, before you ever even use your own credit card in your own name. You're benefiting from this because you have something open in your name, which is, contributing to the length of your credit history. If you're just starting out with credit scores and like credit cards and loans and money that isn't yours, I would suggest looking into secured credit cards or student credit cards. They have a lot of good rewards. I used to use Deserve when I was in college still. They had a lot of good points and like rewards and whatnot. These cards are just a lot safer. There's usually no annual fees, usually nothing like that, and it helps you start building your credit at a young age, which again helps with the average and the longest, which are two of the factors within the credit history that they look into. So there you have it. Those are the three most important factors in your credit score: payment history at 35%, credit utilization at 30%, and length of credit history at 15%. Focus on these and you'll be well on your way to a strong, healthy credit score. If you found this helpful, don't forget to like, subscribe, and hit the notification bell on more tips for mastering your money. If you have any questions or want to share your own credit journey, drop a comment below. I'd love to hear from you, and thanks for watching.